Daniel thought his 780 credit score meant he was winning. Banks approved him instantly. Higher credit limits, better card offers, pre-approved car loans. He felt responsible, disciplined, financially mature. But his net worth? Barely growing. Most Americans believe a high credit score equals financial success. It doesn't. It measures something else entirely. It measures how profitable you are to lenders. A credit score is not a wealth score. It doesn't track assets you own, investments you hold, cash flow you generate, businesses you build. It tracks payment history, credit utilization, length of accounts, borrowing behavior. In simple terms, it measures how well you manage debt, not how well you build wealth. Daniel pays every bill on time. He keeps balances low. He uses credit cards regularly. He's predictable. Predictability is good for lenders because predictable borrowers are profitable. Here's the subtle part most people miss. The ideal credit user is not someone who avoids debt. It's someone who uses debt consistently and pays interest occasionally. Not enough to default, just enough to generate revenue. The system doesn't reward avoidance. It rewards participation. Consider this. If Daniel closed all his credit cards tomorrow, his score would drop. If he stopped using credit entirely, his score could decline. Because inactivity isn't valuable, activity is. Credit scores were designed to protect lenders, not to certify wealth. Banks needed a way to measure risk, so they built a scoring system. Over time, that score became social currency. Employers check it, landlords check it, insurance companies check it. But none of them ask, how much do you own? They ask, how well do you borrow? There's a difference between access and ownership. Credit gives access. Wealth requires ownership. Access feels powerful. Ownership compounds. Daniel buys a car with a low-interest loan. Great credit, low monthly payment, but the car depreciates. He feels financially competent, but his balance sheet weakens. The system celebrates his borrowing, even though the asset declines. The real lie isn't that credit scores are useless. They're useful. They lower borrowing costs. They open doors. But they are not a measure of progress. They are a measure of compliance. Compliance with what? With the borrowing system. Pay on time. Keep accounts open. Use credit responsibly. Remain predictable. None of those instructions increase net worth directly. They simply maintain eligibility. This creates a psychological trap. People chase a higher score, from 720 to 760, from 760 to 800. It feels like leveling up, but wealth doesn't move because a number increased. Assets move, equity moves, ownership moves. The most financially stable people often use credit strategically, but they focus more on asset acquisition, investment growth, business equity, compounding returns. Credit is a tool, not a trophy. If Daniel redirected the same discipline he uses to protect his score into acquiring appreciating assets, his financial life would look different. Same discipline, different target. The credit score system isn't malicious, it's functional. It does exactly what it was designed to do: protect lenders. The confusion happens when borrowers assume it protects them. Your credit score reflects how well you navigate debt. Your net worth reflects how well you accumulate assets. Those are not the same game, and most Americans are playing the wrong one. The shift is subtle. Use credit when necessary, maintain access, but stop confusing eligibility with progress, because the system will happily reward you for staying borrowable, while your wealth stays flat. Credit measures trust from lenders. Wealth measures independence from them. That's the difference. And once you see it, you stop chasing the wrong scoreboard.